Welcome to our class. In this week, we will be learning leverage buyouts. By its name, a leverage buyout, or LBO, means to use both debt and equity to finance the acquisition of a target company. And after a buyer obtains control of a target, a significant portion of future operating cash flow of the target company will be used to repay the borrowed money. The process is called deleverage. If the enterprise value of the target holds constant, then the proportion of debt gets smaller after the deleverage process. The proportion of equity gets larger, and the equity investors can make profit. But the premise is that the target can generate enough cash flow to meet its debt service obligations, and the risks for debt investors largely depends on the quality of the assets of the target. A good LBO target needs to have a solid cash flow generating power and future growth potentials. It is also ideal for a target to have strong asset base, which can be used as collaterals for debts. An LBO is always characterized with a high amount of leverage. The amount of debt largely depends on the overall state of the lending market. Traditionally, the portion of debt may account to 60% to 70% of the purchase price. In some days, the portion of debt can even amount to more than 90%. The purpose of higher leverage is to increase the return on equity. In the next video, we will have a more detailed discussion on the profit model of LBOs. In LBOs, the buyers are usually private equity funds. They contribute equity to finance the acquisitions. The private equity funds are also called financial sponsors, as opposed to strategic buyers, because the PE firms cannot extract synergy from acquisitions. After holding the target company for a certain period, the financial sponsors will try to monetize their investment via a private sale or via an IPO. The financial sponsors typically require an annualized return of more than 20%. Asset management divisions of investment banks also participate in private equity investment to varying degrees. Financial sponsors, i.e. the private equity firms, are important clients to investment banks as well. The industry coverage group of investment banks may have a separate team targeting at those PE firms. Investment banks provide a range of services to facilitate their LBO activities. For example, investment bankers can introduce potential LBO targets to the financial sponsors and provide M&A advisory services during the process of an acquisition. And because debt is always needed in LBOs, investment banks can help with bond issuance. The bankers can also lend loans through their principal investment arm. And at the time of exit, the target may also need IPO services or need investment banks to introduce potential buyers. Okay, in this video, we had a brief introduction of leverage buyout. Thanks for watching. In our next video, we will have a more detailed discussion on the profit models of LBOs.